Hello, this is Jeremy Finger, founder and CEO of Riverbend Wealth Management. We have on the podcast today, or video if you choose to watch it, Malcolm Polley with Stratos Investment Management. Malcolm has been in the business since 1987. He'll tell you a little bit about what specific day that is. He is a CFA, Certified Financial Analyst holder. He's been professor for a few years. He has been in the industry for a very long time. You can see that by his gray hair. And he's been a frequent guest on Squawk Box, CNBC, and a lot of other business shows. So Malcolm, hey, thank you.
Thanks, Jeremy. Thanks for having me.
Yeah. Thank you for having it. I know you're going to get into it with us and talking a lot about economy, where interest rates are headed, where the market might be headed, and it kind of what are some things out there that you look for as guidance. But before we do that, like, what day did you start in the business?
I started in the business on the sell side, which is selling securities, on Black Monday, 1987. Okay. And I remember driving to work that day as the market is tanking. We lost a quarter of the value of the market in one day, thinking, what in the world did I get myself into? And in hindsight, it turned out to be a fantastic day to get into the market.
Yeah. Wonderful. So, yeah, I guess you started when it was low.
Yes. Buy low, sell high, right?
That's right. That's exactly right. Yep. So, well, tell me, what is in your business? So you're a chief market strategist. Mm-hmm. What do you see out there that is top of mind for people in your field?
Yeah. I know a lot of people are chasing, what's the market going to do? What's the Fed going to do? All of it's driven by the economy, right? So is the economy going to grow? There's been a lot of discussion as to whether or not we're going to have a recession. Is it going to be a soft landing, a hard landing, a no landing? At the end of last year, in the a lot of market strategists were saying, for whatever reason, I'm not really sure, that we're going to have 6 rate cuts, which was just silly to me. Because if you think about it, if you're going to have 6 rate cuts, excuse me, that's really telling the market that we're going to have not just a soft landing, which is what everybody was looking for, but a hard landing, a full-blown recession. And that just didn't make sense to me as I looked out into what was going on in the marketplace. The chief issue being, if unemployment rises dramatically during a recession, we have been in a situation for really since 2020 where there have been dramatically more jobs available than unemployed people to fill them. And as long as that relationship exists, as long as there's more jobs available than people to fill them, we should not have a recession as is classically defined, because people are working. Does that mean unemployment can't rise? Certainly, unemployment can rise. But I've always believed that with the current relationship between unemployment and job openings, you probably cap unemployment at, say, 4.5%, which, while it's higher than it's been most of this century, with the exception of the COVID recession, is still largely viewed as full employment. So that's why, in my mind, it made no sense. So we thought initially we're going to get 3 rate cuts, probably pushed to the second half of the year. Market's been catching up to our view. Matter of fact, the market now thinks you're probably going to get 3 rate cuts, with the first one starting in June. My concern right now is, what if the Fed doesn't do anything? Right? So the market's priced for perfection. The market's expecting the Fed to cut rates. The market's kind of pushed that expectation back to June through, say, November, December. But what if they don't do anything at all? And if you listen to what the Fed has been saying, they've been pretty consistent about this, is they're going to be data dependent. And I believe it was Fed Governor Waller in March of this year said, things look like they're okay. It looks like inflation's coming down, but we had a really hot Q4, hotter than we expected. It looks like CPI inflation for January and maybe February is going to be hotter than expected, as is the PCE, or personal consumption expenditures. And if they come in hotter than expected, as the Fed has been saying, is their focus is inflation. If inflation doesn't come down, perhaps they don't do anything.
So what would that mean? Okay, let's play it out.
Yeah.
Let's say,
So,
let's say that is the case, and then what does that mean for the markets?
and that's kind of the discussion we've been having internally. What does that mean exactly? And the kind of the thought process has been, okay, if as long as the rate cuts simply get pushed out, not eliminated, but pushed out, the market probably muddles along. Not necessarily dramatically higher. You see perhaps the market trade down like it is today a little bit. But the reality is we haven't had a correction of even 5% since sometime last year. So it wouldn't surprise me to see a bit of a trade down. But if the market just pushes out the rate cuts, if that just happens, then I think the market's okay and it muddles through. If nothing happens, then you really depend on our earnings growth. And we really think that earnings growth in 25 and 26, which are pretty robust, probably don't happen as hot as the market thinks it is. And that's largely because profit margins are near all-time highs, and you can't really expand from there. So in order for earnings growth to continue, without economic growth happening, you have to have profit margins expand. And we're kind of concerned that that probably doesn't happen. So if we can get through this year, we're probably okay. Next year's probably a little more problematic. Having said that, the market probably broadens out because last year was very narrow. You were limited to, if you didn't own the top 10 names, you underperformed the market by a pretty wide margin. We've seen some broadening out in the market, so to speak, right now. The number of companies participating in the current market move is greater than it was last year.
That's a good thing, right? I mean,
Yeah,
that's a good thing, right?
exactly. I mean, you don't want a market that is purely being driven by the top 7 names, which now the Mag 7 is now the Fantastic Four, because 3 of the 7 are not doing as well. Tesla is being trading down because they actually announced the first year-over-year drop in deliveries in their history. So you're going to have some misses, but it's good to have more people participating because you're not so dependent on 1 or 2 or 3 or 10 companies.
Yeah. So, okay, as an investor, like what are some of the things that if you're thinking this thing may come down, if inflation's coming down, but maybe not as down as much as the market may see, we maybe have a little bit of margin compression, maybe. How does that affect, as a money manager, what do you do how do you execute on that?
So we are long-term investors, right? I'm not investing for next quarter or next year. I'm really investing for the next 3 to 5 years. So while I'm interested in, dislocations that might happen, short-term downward moves are really opportunities in my view. With cash around 5%, it's probably reasonably prudent to carry a little more cash. Okay. If you're normally carrying 2%, carrying 5 or 6 is probably okay, particularly if you're pulling it from the fixed income or the more liquid portion of your portfolio. Because from an asset allocation perspective, and I can explain this why in a little bit later, I really view the bond portion of a portfolio as a higher risk venture today than the equity portion, simply because all I've known my entire career, and really for you, all your career to this point, all we've known is declining interest rates. Yeah,
that's right. That's right.
It's funny listening to when I call young kids, people, in the 30s and 40s, they are really looking at the last 20 years and saying, well, rates are high compared to the last 20 years. Well, yeah, the last 20 years were a statistical aberration. I mean, so yes, rates are higher today than they were over the last 20 years, but compared to normal, they're about normal. Interest rate cycles are very long-term acting. So we just ended a 40-year cycle in 2020, where the 10-year bottomed at 67 basis points. I think I got that about right, within a couple basis points anyway. The last up cycle was from 1944 to 1984. So it's a 40-year cycle. So we just ended
40-year cycle up, like from 40.
Yep. So from 84 to 2020, it was a roughly 40-year down cycle. So if we go 20 to 40 years up, all younger kids coming into the market today are going to know is rising rates. Now, what happens in that environment? Well, from 1984 to, let's say, the beginning of this current rate, the current rate cycle, bonds averaged about 10% a year.
Total return.
Total return. The
Yeah.
last up cycle in rates from 1944 to 1984, bonds, and I'm referring to bonds as treasuries, averaged about 3.9% a year. And it's simply because the number of times you lose money in bonds on a price move perspective, total return perspective, goes up dramatically. I mean, if you've got, and I apologize for the terminology, but if you've got a bond with a 3% coupon, or 4% coupon even, and the duration of that bond, which is the point, and basically tells you how much that bond will move on a 1% change in interest rates. If the duration of that bond is 4 years, and interest rates go up by 1%, the value of that bond drops by 4%, you got a zero return. Yeah. And that's kind of the environment that we're in today, that people are just not used to. Excuse me a second.
Yeah. You got pollen up there too?
Oh yeah, and it's raining, which is lots of fun.
I mean, we're in the South. Everything's yellow. I mean, everybody looks like a bumblebee.
Yeah, everything's green here. It's mold and so forth. So that's lots because of all the rain right now. Yeah. But we're in a unique environment today, which paying attention to risk and having a little dry powder is not necessarily a bad thing. Paying attention to risk on the equity side and owning names that have good capital returns and good earnings projections and not necessarily pushing for the extreme valuation end of the sector is probably a good thing. Early on in my career, I had somebody older than me say, it's not necessarily about winning all the time, but it's thinking about what's the worst that can happen.
Yeah.
And that's pretty good advice, right?
Yeah. So in this like you can win in Russian roulette. Yeah, you can. Yeah, that's fine. And then you die. Yeah. And what good is that?
I mean, people look at returns on a bell curve, and we only focus on the right side of that, positive returns. Nobody focuses on the left side, and that's what can hurt you.
Yeah. Well, they do now when stuff goes down.
Oh, yeah. Yeah.
Oh, yeah. Yeah. Not our clients. Our clients are smart, right? But other people's clients, they're more conservative when things are down.
Right.
And then they get more aggressive when things are up.
Right. Which is, it's buy high, sell low is the exact opposite thing of what you need to do.
Yeah, that's right. So it's, that I hear what you're saying there. So cash, maybe a little bit more opportunistic. Bonds have some inherent risk if we're in a higher interest rate environment going forward.
Yeah.
And then, free cash companies with free cash flow.
Yep.
That are not so high on the valuation scale might be a good place to be. It
might also, and I know they've gotten a bad rap, but there is a whole group of assets now in the alternative investment space. They're called hedge funds. Now don't lock you up and force you to stay in there for 6 months. They're mutual fund based hedge funds. And if you think about what a true hedge fund is, the word hedge means, you're trying to offset some risk, right? There are certain types of hedge funds that allow you to offset the risk in your portfolio to protect you if things go bad. And a small allocation of that type of thing in portfolios probably makes sense because, again, you're thinking about what's the worst that can happen. The worst thing that can happen from an investment standpoint is you lose money. And if you can find ways to reduce what I call left tail risk or the risk of losing money, that really helps the long-term average return on your portfolio. And we've done some of that. We've created some options that allow investors to offset some of the downside risk in their portfolio.
Okay. Can you kind of elaborate on that a little bit?
Yeah, I'll give you an example of just one type of hedge fund. It's one I've used for a long time in my career. Something called merger arbitrage, which sounds really scary, but the reality is if ABC company decides to buy XYZ company, and XYZ is trading at $20 a share, and ABC offers $30 a share, what in cash, what should happen is XYZ should go to basically we call time value of money of $30 a share. So a little bit less than $30, but basically if you put the difference in money market, you'll get $30. What tends to happen is it goes almost to that level, but that difference between what the market is currently pricing XYZ at and that $30 is a riskless profit, right? You know you're going to get $30 at close of the deal. So if you buy the target company and you wait for the deal to close, you'll get your $30, and that difference between what you paid for it and what you got at the end is an arbitrage, merger arbitrage profit. That's the easiest one. If you get it stock, you can do the same thing. It's a few more steps to hoops to jump through. But if you look at the risk profile of merger arbitrage, it looks very similar to cash. Volatility is very, very low throughout time, and I haven't looked at it since really 2021. Actually, I think take that back. Throughout time, I think there's only been 2 times in the history of merger arbitrage that I can find data where companies lost, where merger arbitrage funds lost money. Once was 2007 because a deal didn't close at year end. And had it closed by year end, it would have gone from a negative 0.75% to something like a positive 3%. And perhaps 2021 when everything just fell apart. Other than that, returns are almost always positive. They're not exciting. You're looking at 4 to 6% annualized returns, but the volatility in those returns is very, very low. And so you can put a piece of that in your portfolio, and that piece should be fairly stable and allow you to ride out the very large peaks and valleys in whichever asset class you're looking at. That's just one example of the type of an alternative investment that can anchor portfolio values.
So it can basically smooth out the returns, somewhat like shocks on a car.
Exactly. While it can be fun to ride those bumps with bad shocks, it can also do some damage to the car.
Well, sports cars are fun to drive on a smooth road. You take them down a dirt road, and it's a bumpy ride.
Yeah.
So arbitrage. So when I was coming back from overseas, there was those duty-free shops, and I was able to buy some very fancy vodka at a cheap price because I was in those duty-free shops. And so and then when I gave it as a gift, it was like, oh, this is a really nice gift. But I got it at a deep discount, which is kind of like that's a little bit of an arbitrage.
Yeah. Or what I've heard some people do is like, we used to do this in college. You buy a 24-pack of whatever your favorite beverage is for X. If you break it up on a per can or per bottle price and you charge, 2X per can for what you paid for it, that's a nice profit. That's kind of what you're doing here.
Yeah. And we know what kind of beverage you're referring to, okay? In college. All right. We all know. Okay. Oh, so what else? Is there anything else out there that concerns you? You talked a lot about interest rates. You talked a little bit about, positioning as, bonds, cash. Is there anything else out there that may concern you?
We are in what I call political silly season, and it's really
no. I haven't heard anything about that.
You don't have any political advertisements on TV at all.
No, I'm going to say this to all the viewers and listeners out there. I have single-handedly blocked and deleted and reported spam to every single cell phone number on the planet now.
Yep.
I'm just saying.
Oh yeah. Yeah. I mean, Will Rogers used to say, I'm not a member of any organized political party. I'm a Democrat. Well, I think you can say that about the Republican Party now too.
Yeah, that's right.
And you've got, whether it's the presidential ticket or all the way down, you've got a situation where we really need to have good people elected to office, because you've got a situation now with the federal deficit and national debt that's creating a real problem.
Okay.
A year and a half ago, well, in August of 2021, the annual debt service on the national debt was $500 billion. The average rate on that debt service was something like 2.4%. Okay. Fast forward to the end of this current the last fiscal year, which ended on September 30th, 2023. The 12-month debt service cost on the national debt was $1 trillion.
Double.
The average coupon on that debt was just over 3%. So, we are already starting to see what I call crowding out on debt service. So the federal government is chewing up so much money and for bond investors, because they've got such huge demand for funding the deficit and funding the debt, that they're leaving less and less room for other investors to get money in, issue bonds, so to speak. And that's actually keeping rates artificially high at the longer end, all along the Treasury yield curve. I often said a couple of years ago, if I were king and the last Treasury Secretary lost the opportunity, and the current Treasury Secretary earlier in their career lost the opportunity, I would have issued as much 100-year debt as I could, because you would have locked in your funding cost at historically low levels. But the 10-year Treasury today is at 420-ish. You're basically where it was at the beginning of last year, I believe. Even though people had expected rates to come down, there's been a growing frustration as to why interest rates at the longer end of the yield curve haven't come down any more than they have. Well, there are a lot of different reasons for it. I don't necessarily want them to come down, because that means we have a more inverted yield curve, which is not necessarily a good thing. But the dangers that we have from a federal government funding perspective are getting larger and larger. And what people don't understand is, you look at the federal budget, interest payment and debt service costs on the national debt are non-discretionary payments. You got to make those payments. That means the non-discretionary portion of the budget is getting larger and larger and larger and larger, and we're going to lose the ability to deal with that at some point. It may not be in my lifetime, I don't know, but we really desperately need people in office that are willing to deal with that issue, and that's going to mean probably making some hard choices that nobody has been willing to make at this point. So that keeps me awake at night.
Yeah. I'm going to say this just to kind of age myself. All right. One of the first finances class I took in college in 1991, we talked about this very same thing, the debt crisis in the United States. And here we are.
Yep.
33 years later, talking about the same thing.
Yep.
Okay. Let's pretend for a second that all competent people won't run for office. Okay. Let's pretend. Yeah. And so we're left with the incompetent people running for office. How are we relative to other countries? Okay. So
that's a good question. So in a lot of ways, we're in better shape, particularly in the developed world. So I've been studying demographics, which is basically population, for probably 30 years. I think it's fascinating. From a demographic perspective, we are in better shape than almost all of the developed world. And that's because we've got enough people to, in many cases, fill available jobs and back up. I found it very interesting that since the turn of the century, more than 50% of all the population growth in the United States has come from immigration. And it's had to.
50%?
More than 50%.
Wow.
And the reason is if you think about population growth, if two people get married, how many children do they have to replace themselves?
Two.
Yeah, it's actually 2.1. And the reason it's 2.1 is you do have some infant
People
mortality.
die,
So
yeah.
let's say we
Fine.
need two. The
Yeah.
current birth rate for women in the United States is 1.57.
Yeah.
I think that's, or maybe 1.64.
Yeah.
It's well below the replacement rate. Now we got
Yeah.
close to replacement around COVID, but it's been well below for some time. And the only way you can make up for that is through immigration, which we've been able to do. Much of the developed world is in worse shape. The BRIC nations are, from a financial perspective, in much worse shape. Much
That's
of
Brazil, Russia, India, and China.
yeah,
Okay.
the EU, many of the EU nations, other than you say Germany, etc., the
Right.
larger, are in are in bad, if not worse shape from a debt, federal debt, national debt, sovereign debt to GDP standpoint. The difference is in Europe, for example, all of their sovereign debt is issued by banks. In the United States, it's issued by the federal government and sold to the marketplace. So how we fund that is a little bit different. But it's, so in many ways we're in better shape, but we can't count, and the US dollar is the world's reserve currency. And we should be able to fund ourselves until that's no longer the case. I don't know when that's going to be. It will happen at some point. Does it? I mean, I've asked people off and on over the years. Do people know what the last world reserve currency was? So the answer is the pound sterling.
Yeah, I was going to guess that. Believe it or not, Mal.
So pound sterling was the world's reserve currency prior to the dollar. And I believe it was between World War I and World War II where the dollar became the preeminent currency.
Yeah.
So we've been the world's reserve currency, while it seems like a long time, a relatively short period of time. But as I look out there and see, okay, what options are there? I don't know. I don't know what the option is for world reserve currency other than the dollar right now. It's not the euro. It's certainly not the Chinese renminbi. I don't know what else gets used.
Right. Okay.
So that we got that going for us.
Yeah. Yeah. Sometimes it's better to be with the worst people. You end up looking a lot better, right?
Oh yeah. Yeah.
Yeah. Okay. Understood. Well, I guess, I mean, let's say, for instance, that we're the reserve currency for the foreseeable future, right? We could spend a lifetime theorizing about what can happen, right? And what I try to tell people is that, look, you could predict a lot of things. 98% of them may never happen, or they may happen. But if you eat healthy, you exercise, you save your money, live within your means, you do the basics.
You're going to be fine.
Better. You're going to be better off. And guess what, Mal? Our ancestors lived through the dark ages. I mean, I'm just saying, otherwise we wouldn't be here. Right. So it's like, if it goes bad and we implement certain values and principles, we're gonna be better off. Now, is it
and
gonna be?
And I don't want to come across as a Debbie Downer. I'm really not. I'm generally a pretty upbeat person from a market perspective. Heck, I started on the worst. What's the time? The worst day in history up to the prior to the post crash, 1920 crash.
Well, that was the biggest down day, if I'm not mistaken.
It was the biggest down day in history. I've seen, as have many people that have been in the market, like same day, I've seen, that day I saw 2000 to 2022. I saw the Great Recession and then the COVID recession, some of the worst financial crises in the United States since the Great Depression.
Hey, let me ask you something.
Yeah.
What was the low on Black Monday? I think it was October 19th, 1987. What was the low?
Oh heavens! Now I've got to think about that for a second. I want to say it was like 860.
860?
I think so.
Okay. I
I
don't
could.
know. Let's just say, let's say it's 860.
Yeah,
Let's say it's 860. Where are we at?
we
40,000?
are. Yeah.
Let's say 40,000. 40 times your money over, let's say, what, 35 years?
Yep.
And all the crap that's happened, World Trade Center, 2 Gulf Wars,
Yep.
you name it, all of that has happened. And here we are. And here we are.
Yep.
So, yeah, and I don't think you're a Debbie Downer. And a matter of fact, my questions are like, hey, what can go wrong?
Yeah.
Because like, if we're kind of prepared for that, in a way, as let's just say, as a like fire insurance or
Yeah.
something like that, we can still live in the house. We can still enjoy,
Yeah.
the things. And so that's kind of how I think about it and how we do planning.
Yeah. I mean, I've always looked at the marketplaces. Whereas there's a book, I don't remember who wrote it. There's always a bull market somewhere. And that's true. But I think kind of the corollary to that is if you pay attention to values and prices and you stay away from those things that are clearly overvalued, you might miss some upside, but you'll protect your portfolio on the downside. And in general, you'll do much, much better. I mean, 5% cash, that isn't bad.
Yeah.
Um,
People were screaming for that for the past 10 years.
Oh,
Here
yeah.
we are.
Yeah. I mean,
Hey, and guess what? If
yeah.
you didn't have the cash and you invested it,
Yep.
you didn't miss it because the market's done well.
If your first day of college was 1991, you're probably 10 years younger than I am, which I don't know if you'll know the answer to this question. Do you know what, by law, the passbook savings rate was in, say, 1975?
Ooh, by law,
By law.
passbook savings. And
Yep.
now I know interest rates were very high in the 70s.
Mhm.
So I would tend to guess 6%, 7%.
Close. So I remember going to the bank and when I was a little tyke and got my first savings account, and by law, the rate was 5.25%. And it was 5.25% through most of the 60s into the 70s and starting in, I think, to the maybe late 1970s, early 1980s. And if you remember the savings and loan crisis, that happened because they took the cap off of interest rates and savings accounts, and savings and loans in particular got what I call upside down on their balance sheet. They were lending long and borrowing short, which is basically passbook and CD rates. Rates went through the roof. That dealt with something called disintermediation, bank people pulling their money out of banks because they weren't paying high enough returns and sending it somewhere else. And so their funding costs went through the roof while their asset costs stayed stable. That's what's gotten banks into trouble every single time. They get upside down on their balance sheet. But when passbook savings rates were allowed to float, people got really high rates in the late 70s and into the 90s. And then they came down to zero. So I don't know. I mean, not in my lifetime has, other than say the last 10 or 15 years, have I had to worry about only getting zero in my savings. You got a pretty decent rate. So we're kind of going back to normal, but thinking of 5% as being pretty good, it's not bad. If you look at the yield curve, basically the interest rates at various points in time, shorter term yields of 5.5%, pretty good. I wouldn't want to go too long because, again, if interest rates rise, that value goes lower. But if you pay attention to what you're paying for stock prices, if you buy good companies that have good cash flow, you pay a reasonable amount of money, the noise shouldn't bother you. You'll do just fine over time.
Yeah. Well, and I didn't mention this in the beginning, but all of the wonderful listeners and viewers who stay with us all the way to this point, I'm going to tell you with what I use SIM for some of my clients' assets, and y'all invest money on behalf of our clients, and with the idea of trying to get risk-adjusted returns. And what does that mean? You know, can you just elaborate a little bit what risk-adjusted returns are?
So in its most basic, a risk-adjusted return is basically investing such that you get paid for the risk that you're taking. And far too many people don't pay attention to that. They just want the returns and they don't care about the risk. And it's the risks that can come back to bite you. So we want to participate in the upside. We don't want to participate as much on the downside. So we take great pains to try and invest our portfolio so that in difficult markets, we do much better than the market, and we participate with the market as things go up. And that's what risk-adjusted returns do.
Yeah. The opposite of that, and this is kind of what I will sometimes a client will say, oh, I did X percent, and it's like phenomenal. And I'll take a look at what they got, and I'm like, you're taking an ungodly amount of risk. It's like picking up pennies in front of a freight train. It's great as long as you're faster than the train. But as soon one misstep and you're blown up. So a lot of our clients are retirees, and so returns matter. They do, but more importantly, don't go broke. Right.
I mean, when you're retired and dependent upon your portfolio for your daily living, I mean, losing money is a problem.
That's right. That's right. And so risk mitigation, which is what you guys do very well on, is very helpful. Okay. So Mal, wonderful conversation. I really appreciate you. For all the listeners out there, I've got questions, comments. Certainly feel free to comment wherever you're seeing this, or send us an email, jeremy@riverbendwm.com, or you can call the office 843-970-1049. Can't wait to have you back again. Mal, thank you for your time. I really do appreciate it. And again, if you got any questions, comments about anything at all, just certainly feel free to reach out to us at Riverbend Wealth Management. Happy to help you, shoot you in the right direction. Thank you.
Thanks, Jeremy.